Hello and welcome to session 7 of our basic group accounting course. We've already looked at consideration where it's cash or shares. We're now going to look at a couple of more complicated methods of paying for the subsidiary. The first of them is deferred consideration. So this is where you're told in the question that there is consideration that is going to be paid later. So for example, we pay 10,000 in 3 years' time. Okay, now remember, everything that we bring in here comes in at fair value, and the fair value of that is the discounted amount. You're paying it in 3 years' time. That means we need the present value of that, so we need to discount it back to today's value. So that's going to be step 1. We discount the payments. And then step 2 is we unwind or reverse the discounting until the amount is actually paid. And I'll show you how to do that in just a second. But let's start with step 1. Number 1, discount the future payments. Well, we know that we always debit goodwill, but how much do we do it for? Well, we need a discount rate, which will be given in the question, and the number of years until payment. So what we're going to do is we're going to credit a liability, and to calculate it we need the amount, which in my example up there was 10,000. So 10,000 was going to be paid. And we need a discount rate. Well, let's just keep it simple. Let's call the discount rate 10%. Okay, so we'll do the working for in a second. And it's going to be 3 years' time. Okay, so in 3 years' time is n the number of years until payment. Okay, so the amount is 10,000. The discount rate is 10%. And the number of years until payment is going to be 3 years' time. So let's just do that little working. So this is again for 10,000 in 3 years' time. And the discount rate is 10%. The calculation here is going to be, well, let's do the discount rate first. So 1 over 1 plus, the discount rate as a decimal is 0.10, to the power of the number of years, which is 3. And when you do that calculation, you get 0.7513. Okay, so put that in your calculator and make sure that you can do that calculation. So 1 over 1 plus 0.1, so that's 1.1 to the power of 3. And you should get 0.7513. Therefore, the consideration is going to be the 10,000 times 0.7513, which is 7513. What would we do with that? We're going to debit goodwill, 7513, and we're going to credit a liability with 7513. So that's step 1. We calculated the discounted value of the amount that we're given, which is the amount times 1 plus the discount rate to the power of the number of years. Okay, then I said step 2 was we need to unwind that or reverse the discounting. So we do that with this little calculation. We reverse the discounting by multiplying the opening balance on the liability by the discount factor. Okay, so that's the discount rate that we're given, which is 10%. And we debit the finance cost, credit the liability. Look, I think it's useful to think of this in a little table. So you start off with the opening balance here. You then unwind it by multiplying by the discount rate, which was 10%, and that gives you the closing balance. So, for example, year one, we had an opening balance on the liability, so we credited the liability of 7,513. We'll unwind the discount, so 7,513 times 10% is 751, and that gives us a closing balance of 8,264. So we just add that across. That comes in as the opening balance for the next year, 8,264. We unwind that again, 826, so that's 8,264 times 10%. Add it across, and that gives us 9,091. So each year we are crediting the liability to increase it, and we are debiting a finance cost. So in the final year, the opening balance was 9,091 times 10% to get our finance cost is 909. That also increases the liability, and that finishes us off at 10,000. Now think about what's happened here. We discounted the initial 10,000 at 10% and created our goodwill based on that. So that's this up here. So we discounted it, created goodwill and a liability. The liability started off at that amount, and then we have unwound it each year, reversed the discounting, treated it as a finance cost, and that has increased the liability. So each of those amounts in each of those years will have been debited as a finance cost and credited to the liability. Okay, so that's the treatment for deferred consideration. You step one, discount it back to today's value, and then step two, each year you unwind that discounting, you reverse it, treating it as a finance cost by multiplying it by the discount rate given. Okay, as per usual, this can be a little bit confusing until you try it. So let's have a look at this one. So this is an example of deferred consideration. They're going to pay 300,000 in 3 years. Discount rate's 10%. How should they initially record it? And then what's the finance cost in year one to unwind that discounting? Pause the video now, have a go at that calculation, and then I'll take you through it to make sure that we're on track. Okay, hopefully you've had a go at this. This is going to be somewhat similar to what we did in the previous example because we've got 3 years and a discount rate of 10%. So that means that when we calculate the discount factor, it's going to be the same as last time, 0.751. So looking at the answer, the present value is going to be 300,000 times 1 over 1 plus 0.1 to the power of 3, which will come to what we had last time, which was 0.7531. When you multiply those together, you get 225,395. So that means we're going to debit goodwill, credit the liability with that amount, and then the discounting will be multiplying the opening balance on the liability, which is 225,395, by 10%. Debit finance cost, credit the liability to increase it. Okay, so hopefully you did okay on that one. It only asked for year one, but then you'd go on in years 2 and 3 like we did previously to do the unwinding then as well. So as it says here, the deferred consideration initially recorded at present value, and then we unwind each year with a finance cost to P&L. Now, just before we finish, there's one more type of consideration, which is contingent consideration. It is the same as deferred, as in the treatment is the same as deferred, but probability weighted. So what does that actually mean? Well, Contingent consideration means it might be paid. In the future. Now, it's not certain. So if you're certain it's going to be paid, well, that's deferred consideration. But if you're not sure, well, then you do the same treatment as deferred consideration, but you probability weight it. You multiply it by whatever probability they give you in the question. If they don't give you a probability, then just treat it the same as deferred. Okay, if you didn't meet the conditions, so for example, they might say, we'll give you 1 million up front and 100,000 in 3 years' time if you meet certain profit targets. If you don't meet the profit targets, well, then you remove the liability through P&L. So debit liability, credit P&L to remove it. Okay, so the initial treatment is debit is always to goodwill, credit is to the liability, and this time it is the amount discounted, the same as we did with deferred consideration, except probability weighted as well. Okay, let's have a go then. So this example gives you a chance to practice your discounting, and there's a probability weighting to do in there as well. So calculate the amount up front, and then you can do the unwinding as well if you want to do that, but I'm more interested in just calculating the upfront amount that we would include in goodwill. So pause the video now, have a go at that, and then I'll take you through it. Okay, hopefully you've had a go at this. Company P acquires Company Q. They're going to pay 400,000 in 2 years' time, and the discount rate for that is 8%. So that's for our calculation, but they're only going to give it if they get certain performance targets. So that means it is contingent consideration rather than deferred consideration. That means we need to multiply by the 60% probability that they're actually going to have to pay it. So same calculation as deferred, multiplied by 60% probability. Okay, so the calculation then is the 400,000 multiplied by 1 over 1 plus 0.08 for the discount rate, this time 2 years. And when you do that, you get 342,935. But don't forget, you need to multiply that by the 60% probability that we'd have to pay it. And that then is the amount that we bring into our goodwill calculation, 205,761, debit goodwill, credit a liability. Remember, if that liability did not need to be paid, for example, the targets are not met, well then the liability is reversed. But you don't do it through goodwill, you do it through the P&L. So the treatment for that would be debit liability to remove it, and credit P&L. You do not take it to goodwill. So that's the key thing here, is there's a temptation because the initial debit was to goodwill that you would take it there. You don't. Okay, so remove the liability, debit liability, credit profit or loss, not goodwill. And that would be the same if the probability changed or something like that. If the liability changed in any way, we would need to do that treatment through P&L. Okay, that is our session on contingent consideration and deferred consideration. In the next session, we'll do a comprehensive example to bring all of our consideration together, just to make sure we could do all of those treatments.